Thanks very much, and thanks to all of you for coming. This is a really nice event in the sense that there's a wonderful world that these people represent that I presume all of you are interested in. Many of you know a little bit about it. All of you, I think, will be enticed by it, but that's part of what we're up to here. So thanks for coming. We'll do our best to give you a clear and candid perspective of this world. It's not one that's so easily accessed, I think, for people who aren't close to it, and that's one of the reasons why events like this have so much value. I thought the way we would structure this is to take just 2 minutes. You have the biographies for everybody up here, but just to take 2 minutes for you to get a sense for what they're up to and how they think about themselves and their place in this part of the industry. And then we will move it to Q&A very quickly. So be thinking about now the sorts of questions that you want answered. Some of those questions, I think, will basically evolve into discussions, and we'll have room to do that before we have to close by 7:30 at the latest. But do be thinking about some of the things that you'd like to hear most. I'll turn it over to the far end of the table, and you give us a couple of minutes. Thank you.
I thought by sitting here I'd be the last person to go instead of the first person to go. Thank you. My name is Greg Berman. I am at Riskmetrics, and I have the business group there. My bio is on the back. I think what we wanted to do is just give you a little bit of an introduction on how did we get into the positions that we're in today prior to starting with the questions. So the first question was how I became a quant. I'd actually make that into two different questions. How did I become a quantitative person? And then how did I actually move from being a quantitative person to being a quantitative person in finance? How I became a quant, I can sort of pin the day. That was roughly September of 1974, something around that. When in grade school someone showed me a computer as one of those big giant machines with, forget screens. It looked like a fancy typewriter, and I got extremely interested. And since then I became very interested in anything that's quantitative. I had two parallel choices. The first choice that was to think about quantitative, getting David telling me to put the mic there, but there we go. The first choice was to start thinking about things in a quantitative fashion, and I wrote a little simulation to simulate horse racing and gambling. And not that gambling has anything to do with Wall Street at all, but there are certainly some similarities. And then I was asked by one of my grade school teachers to write a program that sorted through different teachers' categories and make a dating matching service. So this was an online dating service in 1974. I discussed it with some other teachers and said, bad idea, not something that's going to fly particularly well. And that's how I became a quantitative person who was very interested in the mathematics and probabilities, etc. I went into physics and spent a lot of time on the science side of things until after I was finishing up graduate school. There was a fortuitous set of events by which I was contacted by a recruiting agency who they had a hedge fund who was looking for someone with quantitative skills who knew nothing about Wall Street. And I said, well, this is great. I know absolutely nothing about Wall Street, though I do know a lot about horse racing and odds and betting. And they said, well, don't mention that part. They'll be a little sensitive about that. So I had lunch with the hedge fund. We hit it off. They made me an offer 2 weeks after that. I accepted right out of graduate school, and basically I've just sort of went through my entire life in less than 90 seconds, and that's how I became a quant.
Wow. My name is Alessia Falzarone, and I am actually with the Global Investments Group within Citigroup Global Wealth Management, currently based in New York. I became a quant much more recently, actually, in 2002. I was previously an investment banker, both in New York and Chicago and other geographies. After investment banking, particularly leverage finance, and after living a super great life when really everything was up in markets, I got also through a couple of troughs in the market, and I started realizing that there were a couple of anomalies that were not exactly reflected into the standard models that you would see, like, discounted cash flow that could explain or anything like that. So I decided to go actually back to school, and I attended a Master in Financial Mathematics at Stanford University I got in the program and was run at the beginning. I was supposed to be run by the mathematics department. Ended up that, when I got to campus, I actually realized I was run out of the statistics department and in cooperation with the business school and a couple of other departments. And I said, great, I hated my statistics class when I was in undergrad. I'm going to have the worst life ever. And I signed up for a couple of years and, wow, I can't believe it. And I was, in my mind, it was all the opportunity cost of leaving, Wall Street, investment banking in particular. And this was like, in basically 99, 2000, and, getting into school at that time. So opportunity cost was extremely high. And then I realized after not even, I think, 15 days into the program that, I was the biggest fan of statistical studies ever. I loved the program, and I decided that I really wanted to go back into the markets and do something about, quantitative strategy for portfolio allocation. I was thrilled by the opportunity, actually, of getting into Citigroup when they were starting their investment research coverage for portfolio allocation within small and mid caps for institutional investors out of San Francisco. They were opening the desk, and I was like, great, just just a couple of, not a couple of miles, but 20 miles from campus, and the joy of continuing being in California. Stayed with them in California for a couple of 3 years, and then I transitioned last year back to New York. And right now I cover multiple asset classes, multiple geographies for private investors that are really willing to put their money to work in the most sophisticated way ever, but that are all alpha generators, and they're not black box. They understand fundamental analysis. They don't just purely believe in fundamental analysis, and they want a clear quantitative rationale behind what they do. And so far it's been just fantastic. And I think I've been a YAFE member since I joined my program at Stanford, and so far it's been just a great association.
Thanks, Alicia. Jonathan?
Hi. First, I wanted to say happy spring. I think it is spring officially now. So, last Friday I was down in this neighborhood a couple blocks from here during the snowstorm, but 80 feet below the street level, there wasn't any sleet, there wasn't any slush, wasn't much noise, but there was something significant, namely $140 billion worth of gold in the gold vault at the New York Fed. And that got me thinking, how I first learned and got interested in economics and finance. I was an undergraduate at Princeton in the 1980s during the stock exchange boom under President Reagan. And I majored in physics. I was thinking about going into biological physics. I did see John Nash of A Beautiful Mind quite a few times. Not really a topic for here, but pretty scary guy at that point. But I got interested in economics courses, and what I really liked was how does the Federal Reserve work? How interest rates are the price of borrowing or lending money, how international trade works, just in basic economics courses. But Princeton didn't like double majors, so I decided to apply to PhD programs in physics. It had to be, in other words, either physics or finance. There were none of these math finance programs around. And I thought I was going to do particle physics or solid-state physics. I did have a very close friend who ended up working with Fisher Black here at Goldman, and I sort of watched his career. Mine was more or less straight in physics for a while. I went to Berkeley and got a PhD in compact objects, which is sexy things like black holes and neutron stars and white dwarfs. But I got interested then later when I was a postdoc in the astronomy department at Harvard in stock options. The first reason was that my girlfriend at the time was a single mom and hadn't saved any money for college for her children. She basically, her family, she was from Moscow, and, people didn't really save money then. And I was like, well, with a lot of leverage, then maybe she could pay for college. So how much leverage do I need? Anyway, so I started trading options, not with her money, with my money. And I made money, trade options. I bought 4 calls, and I made money, and I got hooked. So even though my last 4 years at Harvard, I was working on the Chandra X-ray Observatory. That's a NASA observatory in the same class as the Hubble Space Telescope, which was launched on Space Shuttle Columbia. Yes, the second one that blew up. But it didn't blow up while our equipment was on it. And so when that wound down, I was newly married. I was like, Well, X-ray satellites launch about every 20 years. Do I want to wait another 20 years for another launch? So I decided to seek an alternate career, and that's when I sought out my old friend who had gone directly to Mikado Metals and then Goldman to work with Fisher Black. And so I benefited heavily from contacts from the Princeton Alumni Network, from IAFE, from Quaff a few in that search, both in Boston, where I was originally based, and then New York. I ended up landing a job at J.P. Morgan Chase in corporate bonds based on my analytical skills, but also on my programming knowledge, Perl primarily.
And effervescent personality.
And effervescent personality. I've probably talked for 7 minutes at this point, right? I registered as a part-time, mainly an evening student in the Columbia Mathematics of Finance program. And I started on Wall Street at Chase in April 2000. And that week, the NASDAQ went down 10%. And if I have a couple more minutes, I'll just say my first day at Chase, now J.P. Morgan Chase, I showed up in a suit. Okay, why was that funny? Well, it was April in New York, so it was hot, and the air conditioning wasn't working that well. But also, between the time I had interviewed in February, March, and the time in April when I actually got to J.P. Morgan, they'd become business casual. So I looked like the biggest idiot wearing my best suit. I think there's some sort of moral to that you should keep in touch with the market or keep in touch with a job. And anyway, I'll finish with that.
Thanks, Jonathan. Andrew.
Okay. I just thought I would use this as a plug for a book that's coming out. The Fisher Black Memorial's publishing a book on how I became a quant. And so I just thought I would read a little bit about me, because after all, it's all about me. It isn't actually just one chapter. So I went to Columbia forever, and this is sort of beginning just as I'm leaving Columbia. Okay. Upon the completion of my coursework and comprehensive exams, I began a consulting relationship with the foreign exchange department of Shearson Lehman Brothers. The basic terms of the relationship were that I would deliver econometric voodoo through the use of such forecasting tools as vector autoregression, autoregressive integrated moving average models, Kalman filters, for the purposes of forecasting movements in the foreign exchange markets, and they would teach me the dark art of speculation. There was, of course, a vast array of literature being produced at the time, this was the mid-'80s, by the giants in the field of rational expectations econometrics, such as Robert Lucas and Thomas Sargent, which clearly demonstrated through the use of well-structured tests of market rationality and neutrality that such tools were likely to prove useless. My feeling, however, was, while let that get in the way of a good time, if I could just cleverly restructure some of the independent variables, focus the research on a highly granular time frame, use a complex enough model, then who knows, let's turn up the juice and see what shakes loose. The firm was, of course, eminently capable of delivering on its end of the bargain. I, on the other hand, muddled along, testing model after model to little effect, all the while trying to make sense of my surroundings. I was to discover that graduate school had prepared me in a decidedly tangential manner for what I was about to encounter. The foreign exchange markets, which I had studied extensively in the context of purchasing power parity, uncovered interest rate parity, and geometric Brownian motion, were almost unrecognizable to me. I frequently felt lost in a world of rapid-fire economic and political developments, blaring broker boxes, and arcane market nomenclature. It was as if I had embarked on a career as a professional pugilist, armed with an extensive knowledge of anatomy and the basic instruction set that I must strike my opponent firmly about the head and abdomen while avoiding same. It was some time before the observed phenomenon were to come into focus. After a year at Shearson, my boss transferred to Bankers Trust and invited me to tag along. It was there that I had my first epiphany as a quant researcher. It consisted of the fundamental realization that most of the trading that occurs on the interbank trading desk takes place on a time scale that, for the most part, defies fundamental economic analysis. In truth, longer-term market convictions based on well-structured defensible analysis were apt to get in the way. Such speculative activity is more akin to playing Pong. I footnoted this, and when you read the book, that's how I got all the over-the-line dirty bits in, and the editor missed most of this. So Pong, the reference to that is I date myself, of course not in a romantic sense, but rather temporally. It is primarily a reflexive activity with the trader operating under no imperative to distinguish Margaret Thatcher from Terry Hatcher. In many cases, doing so would have been a tall order. Okay, so that was the beginning. And one little paragraph. Actually, I'll just go straight to the end because I don't want to hog everyone's time. So I was talking about one of these big disasters that I'd encountered and what I'd learned from it. And basically, one of the things that I've learned is never talk to reporters. And this is really a discussion of why that happened. Because basically, I had a conversation with a reporter from Institutional Investor where I was summarizing some of the opinions. I offhandedly commented that as hedge funds find their way into the investment portfolios of Joe Lunchbox, there will be an associated migration of higher-order statistical concepts. Most people know what an average is. A small but significant number know what a standard deviation is. However, as Joe Lunchbox starts earning 1% a month for 48 months in a row and then gets clocked for 30%, he's going to learn all about kurtosis. At the moment, though, most people think kurtosis is some form of a skin disease. These comments convulsed the reporter, who promptly sent a photographer over to my office to snap a less than flattering image of me. It was subsequently published in a full-page spread in Institutional Investor with the byline, "Living with Kurtosis." It was several months before strangers were bold enough to shake my potentially disease-ridden hand. Okay, and finally, as I move forward into the latest chapter of my life as a quant on Wall Street, I do so with an emboldening realization that senior Wall Street management has finally come to understand that investing is an intellectual arms race. You really need the involvement of those who find joy in the inner workings of the genetic algorithm and the Gaussian copula. Besides, quants tend to accent the workplace in the most positive and entertaining ways, and there's no shame in enjoying your life. So that's what I have to say. Thank you.
Thank you very much, Andrew. I'll just say a few quick things about myself. These folks are the real doers. I'm up here, I think, primarily because of my former role. About 4 months ago, and before that, I was at UC Berkeley and teaching in what we called there the MFE program, the Masters in Financial Engineering program. The course that I taught was currency markets, so it was interesting to hear Andrew speak to that, thinking a little bit about as you start migrating a lot of the trading to electronic platforms, you obviously have archives of the data, the trades. You can ask, dollar for dollar, why does a hedge fund trade move a market price more than a corporate trade, and under what market conditions? It's a fascinating area. In any event, the MFE program, like many of the programs that you're considering or are in, are programs that really have, 10 years ago, lots and lots of schools were saying, look, there's a missing market here. We have a lot of people going into PhD programs that don't intend to do research. And that's at some societal level, just a waste of resources. Let's get some programs together that fit people to what they want to do. And these things are doing very well. The channels that connect you from these programs to the jobs that you want are much better developed today than they were even 3 or 4 years ago. This is really institutionally maturing very, very rapidly, and it has made great strides. So it was exciting for me to be part of that as it was occurring in many universities, not just Berkeley. Currently, now I'm at Goldman Sachs, I'm the Chief Learning Officer. So my role here now is still an educational one, and thinking a little bit about this sort of material and the way it gets delivered in the corporate setting is something that fascinates me, obviously, in my current role. But that's not what we're here to talk about. We're here to talk about why you want to become a quant, why they became quants, and sort of where this segment is moving. So we'll open it up to questions now. If you have one, please offer it. Let me ask the first one, if I may, and this will, in some sense, reflect my own academic background, but I think it's kind of fun to think about this question. And that is, as we think about financial markets getting more and more efficient, then why isn't this game sort of winding down? Why isn't the payoff to investing in quant skills getting less and less valuable as markets get more and more efficient? Why is that the wrong way to think about where we are? Any comments on that? Admittedly, sort of big picture question. But obviously this is a vital industry and getting only more so. So how do we understand that with very, very efficient markets?
I've actually given that question a lot of thought. When I first joined the first hedge fund I was at, the boss came over to me and said, "Great, so your PhD, you have physics. I only have one question. I want to know, are we going to keep making money in this hedge fund, and for how long? And by the way, why do we make it, and what do we do to make more money?" And now that I've told you that, so I've done the hard job of coming up with the question. Now it's the easy job. And he actually did say, just go to Bloomberg and type it into the terminal and see what the answer is. So I spent 5 years working on that because I was deathly afraid of would this dry up over time. And I think it depends on why you think there's money to be made in the markets at all. And there's different ways of looking at the markets. What I think I've observed over time is that people trade different things at different levels of granularity over the years. So it used to be that you would just invest in, quote, stocks and be done with that. And that was just the S&P 500 or the FTSE, and you were finished. Then you found out that actually not all stocks move exactly the same way. So as, quote, the market as a whole became extremely efficient, individual stocks still had differences. So you moved one level deeper. Then when you found that actually many stocks move all in the same pattern, you would find things like, yes, but IBM traded on Zurich has a slightly different price than IBM traded on New York because it's a different time zone, there's a little bit of a currency hedge, etc. So you'd move one level deeper than that. As long as there are folks in the world who are interested in seeing if they can find outsourced places, they will find outsourced places where outsourced returns can be made. And when they run out of finding those things, they will make up new things and new paradigms in order to find those. So a good part of what we do on Wall Street is come up with new structures that are interesting, that people can then arbitrage later. And that's been happening for 50 or more years, and it's unlikely that that's going to dry up at any time.
Great, thank you. Very helpful. Anybody else want to?
I've been spending a lot of time on this one as well, just because if I don't, then I will ultimately get fired. I didn't say what my job was. I'm actually the chief investment officer at Merrill in their hedge fund area. So this is something we do spend a lot of time thinking about, and thinking about it both qualitatively and quantitatively. In a quantitative framework, I think there is an observable tendency, and what we did was essentially an application of a Chen, Roll, and Ross type framework where you posit certain risk factor exposures, you regress them against a manager or a strategy class. You do it on a rolling window basis, collect up the intercept terms, and plot this path of alpha over time. And just to see what it kind of looks like from a general tendency. And what you see is something that is somewhat cyclical in nature. So there's a natural tendency for markets to become cheap and a natural tendency for them to become rich. And that has real implications for risk management. From a qualitative perspective, the real issue is when I go visit a manager, I'm really thinking two things. And these are my sort of guardians of alpha, if you will. Number one, is this guy trafficking in a security for which there is a relatively rich inefficiency set? Classic example, the GKO market, Russian T-bills circa 1995, yielding 140%. You could take 5% of your portfolio, put it in there. Bob's your uncle, you're earning an extra 700 basis points without assuming a whole lot of risk. 2 years, 2.5, 3 years later, when they're yielding 30%, it's a whole different ball game. So there's this notion of a rich, cheap opportunity set. The second one is, does this manager I'm meeting with have some sort of a proprietary knowledge base that allows him to participate in the market and command some form of a monopoly rent? Great example, ConvertArb, circa 1995. If you wanted to participate at that point in time, guess what? You needed a guy that was real handy at stochastic calculus, could program, understood how to transact in the securities, and could set up a business and run it. Today, guess what I can do? I can go to J&R Music World around the corner, get state-of-the-art software for calculating my hedge ratios properly, hire 3 low-level clerks from an existing shop, and within a month, Bob's your uncle. Once again, I can be in business. Not that I'm suggesting that you do that, but you could. And that's why there's not a lot of juice left in that strategy at the moment. So the real issue is, and it really happens from two perspectives. Number one, there is a natural sort of cycle of rich, cheap, people blowing up because things got too rich. there is a natural tendency for proprietary skill sets to diffuse throughout the world. And so, you get guys coming out of the prediction company and they go and visit Izzy Englander over Millennium and he sets them up in business and they cycle around and then eventually everyone knows how to do something and you have to move on to something else. But I think people are endlessly creative. I think that there's always some other way of, turning it around and looking at it from another angle. But this is at the heart of many of the kind of peso problem issues that we face, these outsized loss situations that develop when securities become essentially too rich and when everyone knows how to do the trade, and the payoffs have migrated to something that's not so attractive anymore. So that is at the heart of asset allocation. So I give him an A for that question.
Great. Those great thoughts. I think that notion of renewal, that next level, next thing to be done, I think in a lot of these shops, if you had somebody 5 years ago that went to sleep for 5 years and woke up today, that menu of trades would look very different. And that renewal and almost limitless capacity for it is part of what makes this so darned exciting. Questions from the audience? Anybody? Please, sir.
All of you are seasoned professionals. That's why you're on the panel. So when you first started out as a quant, what was your job typically like? What did you do on a day-to-day basis? And also, what do you do now? Now, what is the kind of if we want to be a quant, what's the long-term thing? What's your day-to-day responsibilities now? Is it going off to conferences, looking at other models, trying new models out? What's it like when you first entered? What's it like later on?
Thanks. So I'll repeat all the questions to make sure everybody has heard them. The question is, when you first started in your career as a quant, what did it look like day to day, and what does it look like now, day to day?
Okay, I'll take that. Let's say, and I completely agree that life has changed in the last 3 to 4 years. Once again, for me, has changed dramatically since I actually graduated out of the financial math program in 2003 to today. And I have actually transitioned to a new position last year. When I first started out of the program, I was doing anything that a pure quant does. That is, you just start modeling from scratch. Actually, I joined a desk that was just launched. That means you don't have anything. You need to build the models, you need to validate the models, you need to do the back testing, you need to explain that and communicate that to clients, you need to win almost clients and their votes, because I was actually in a strategy within an equity research department. That means you don't get voted by institutional investors, you don't have a P&L next year. So once again, and you are basically competing with the rest of the street, because the clients that call in, okay, there are most likely are either risk managers or there are actually investment analysts within a hedge fund. They're not going to trust your model. They want to know what's behind that and what drives your rationale, but they want to talk to you as they're talking to a peer. They're not coming to you because they rely, on your model, and then they're going to buy XYZ asset because you said so. But they're going to rerun their models, and what they want to do is they want to run through the intellectual exercise, that basically is, that drives all your assumptions. And the basic idea is, when you are, especially in a strategy position on the sell side, everyone else, the chance that you're smarter than everybody else is really slim, just because your audience is so huge. And it's the entire world, how many, buy side actually centers you have around the globe. So that was really challenging. That meant lots of, long hours, a lot of building the model from scratch, a lot of programming, also a lot of, let's say, business development, in the sense that, what do I really need? I remember my manager coming to me, okay, I was the only one with the, kind of quantitative background, saying, okay, and he was a double E, so great, an engineering background, so we were, speaking almost the same language, but on the other hand, even him being a seasoned professional, he just wanted to know, okay, what's the latest, tool that we need? Okay, we have the budget. What should we buy? Should we get this kind of software or this other one? What do you need? Do you want C++ or do you want to use Perl, or do you absolutely need MATLAB? Do you need whatever it is? Just tell me. So that was kind of, and these are your tools. So I'll provide you with the tool set, and then you go and, complete, and do the rest, and then we'll validate. So that was at the very beginning. Okay, it was extremely entrepreneurial in a way, challenging as well. On the other hand, it was, you build your knowledge base on a trial and error type of, idea, because you're not really part of a huge group, and actually quant groups, in a way, within the same firm, sometimes compete with each other. Okay, that's the point. So that was at the very beginning, and that I was in that role for a little over 2 years. Okay, when it went by very fast, and they were just incredible. I think we worked so much. We had a fantastic product. What I transitioned to right now, I was before specializing in equities, okay, just pure equities. I transitioned to a new group that handles global investments for the private sector. So think about private investors that put together, they have a pool of money that they need to allocate, and they are, interesting enough, absolute return investors. That means at the end of whatever review period they have, they buy with you, they participate in, any sort of asset allocation that you created for them, or in any type of deal that you ask them to contribute to, and they will review their performance benchmark to themselves. So if the index or whatever, global index is down 3% and they're just down 1%, that's not positive. That's still negative. They still remember you for being, down, 1%. Okay, so it's very slim the chance that they're gonna get, with you. So what I do right now, though, I'm not modeling, okay, like a pure portfolio allocation. I'm reviewing, models that, are institutionally embraced by the company, and I'm communicating, those models to product development areas where they say, okay, we have this asset allocation model. Actually, to be very honest, we have added, for instance, commodities as an asset class really recently. We were not considering commodities as a standalone asset class. And on one hand, we didn't have the skill set in-house to do that. Once you have that and you treat commodities as an asset class, how do you actually go ahead and study that on an opportunistic, perspective, on a short-term trading, or on a more longer-term, view on that particular, area? On the other hand, also, the most important thing, and I think what requires a different skill set that I'm developing right now is, okay, you're a great quant, and you understand when you see something, okay, just, half a second you understand if something is wrong or not, but how do you communicate that to the end client? Or by the way, how do you communicate that within your firm to people that actually maybe have not your background, they're not as sophisticated as you are, right? But they are part of that decision-making process within a firm. And, some of them may be, your managers or the manager of your manager, okay? And they have a specialized skill set in something else, and, they need to buy in or not your idea. And they need to be your sponsor, for a new product development or for something else. And that's extremely difficult. What I'm finding actually, even with the new recruits that we have from, a quantitative background, that what we work on very intensely is to build a sort of communication skill that is extremely important to me. Every time I talk to somebody, an external manager, an internal one, if they're not able to tell me the story in 5 minutes, and I have this blurry sense that they don't really know what they're talking about, or I don't understand what they're talking about after 5 minutes, then I start questioning also their, just quantitative background as well. Because I think math actually and statistics is really very logical and streamlined way of presenting facts. And in a way, you're not presenting an opinion. Okay, you're presenting a fact. And you have to have data to support it, and you have to have your, strong will of being able to present that internally and to back that over time. A lot of people just lack that.
Very helpful. Thanks, Alicia. Anybody else want to add a quick comment on that? We could go to the next question. Would you like to, please?
I'll do a quick comment. I think that ties a couple of things together. There's no such profession as being a quant. You can't find them by looking in the New York Times or the Wall Street Journal, quants wanted. Being a quant is a skill set. Can I see a show of hands? How many people are coming from a hard science, physics, chemistry, etc. Looks like about 19.2, 19.3% of the people here. Okay. Given us with a standard error of probably plus or minus 15. It was funny that Jonathan mentioned this X-ray observatory, Chandra. Right before that, it used to be called AXAF, for Advanced X-ray Astrophysics Facility, and I spent 4 years modeling the electron flow through charged coupled devices. CCDs are the things that you find in digital cameras now, and you can buy them for $100. I had the first one, and I actually almost broke it. But that's a very long story. And I had hair in that day, then this happened the next day. So what does that have to do with finance? It has nothing to do with finance. It has everything to do with being able to master the quantitative aspects of something. It doesn't matter what that topic is. You can be the best person at estimating the number of blades of grass on a lawn. That's what it means to really be a quantitative person. When I first started in the first hedge fund, it was all around data collection. It was understanding data and modeling data and doing simulation. I said, well, if I can simulate an electron through a charged coupled device and not break it, then I can probably simulate a stock price. It's the same skill set. And I think as what Richard was saying before, and I think Andy, things ebb and flow. If you wake up in the morning and saying, what I really want to do is be the best quantitative convertible arb trader, then you better be able to time the market right so that when you're looking for a job, convert arb is where it's at, because it'll disappear and it'll come back later and you might miss it. So you need to think about skills primarily, quantitative skills, and take what you learn here and apply it to here, then apply it to here, and then apply it to here, because you don't know where you're going to wind up going. So what do I do today? I spend most of my quantitative skills arguing with clients about price negotiations and SLA commitments, which has absolutely nothing to do with modeling data and nothing to do with charged coupled devices. But I would call myself a quant. It is exactly the same skill every time.
Thanks, Greg. There was a question way back there, sir. Please.
I'm interested in what the aspect of quantitative analysis has meant to the markets overall. For instance, when Markowitz came online, what happened to the market? And can you expect some kind of limit where you'll settle on some kind of set of models? I also want to look at the market as either a competition for investments, or is there some kind of large economic gain that you can expect from a continued evolution of quantitative analysis?
Okay, so the question was with the advent of quantitative analysis, is how has that changed the very markets that we operate in? And do we think of it going forward as sort of competition between models as they get perfected? But the main question is really, what's the impact on markets as opposed to taking markets as given? Clearly, this is having an important impact on markets.
Yeah, can I
Please
comment a little bit on that? The two areas where I work in numerics, and we work on a number of different asset classes where it's necessary to go to cutting-edge mathematical models. So the two areas two or three areas I think under development are, for instance, in credit, especially basket credit, being able to understand correlated defaults is very cutting edge. I would say credit is most of the papers that I've seen in mathematical finance the last 5 or 10 years. And that's one of the most rapidly growing areas. Fixed income is also significant as well. Particularly putting stochasticity or stochasticness into the LIBOR market model, and certainly the LIBOR market model would have to be one of the great achievements of the late 90s, early 2000. But they're very active areas of research. For instance, everybody uses the Gaussian copula model, just like everyone uses the Black-Scholes equation. And I think from an economic standpoint they make sense, but from a financial standpoint they don't. But everyone's going to use them. Everyone's going to talk about base correlation coming from them. I think what's cutting edge for me as far as new products, yes, commodities, but also insurance, like catastrophe bonds, to the extent that these things become, instead of just bilateral, if they become, if they're secondary trading of these things. We've seen a couple of papers on catastrophe bonds, and we want to step into that space, the insurance product space. Inflation is another area that's active research.
So could you, it's sort of, but that sometimes people use the word reflexivity, but that notion that in fact markets trade and feel differently when these strategies are pumped into them. Do you have some sense that they feel and trade differently as a result of these?
Well, if you look at the spread, yeah. I mean, look at the tight spreads in the CDX market, for example, a couple of years ago compared to like 5 years ago. I mean, when I was initially at J.P. Morgan Chase, there was only the 5-year credit default swap, and it was only quoted weekly or something like this. Now any idiot can get, the CDX. You can get all the names, 125, just a couple of basis points.
So there's a liquidity enhancing effect that's
exactly
powerful.
It becomes a commodity.
Thanks. Are there other effects that you've noticed?
Yeah, actually, one of the most, seems like every time I talk, someone's phone goes. There was a really interesting paper that got written about a year and a half ago. Actually, it was published on November 17th, I remember, 2005. And basically, the author was attempting to deal with the issue of why is it that we were observing what Alan Greenspan has been calling this sort of anomaly in the marketplace, the fact that markets weren't, from his opinion, given, for example, the flatness of the yield curve, really reflecting risk premium properly. And he went on to paraphrase some of the arguments that Alan Greenspan was making, and they really related to the effects the financial engineering were actually having on the marketplace. Most notably that through the advent of financial engineering, you've been able to take what were previously pockets of risk that sat on the balance sheets of banks and insurance companies and syndicate them. And subsequently, for any given shock, the market as a whole is significantly more stable than it had been previously. He then, however, in a curious twist, went on to invoke a sort of a psychological or behavioral notion, something known as risk homeostasis, constant risk. And to explain this concept, he talked about automobiles. Today's automobiles have side impact airbags, rack and pinion steering, anti-lock brakes, yada yada. By any stretch of the imagination and under any criteria, these are substantially safer automobiles than were available 50 years ago. And subsequently, though, humans tend to accommodate this by driving a whole hell of a lot faster. So we're no safer now than we've ever been. So, one of the things that we discover is that life is out of sample. And I think some of the sort of the kind of risk that we're going to be exposed to. Actually, one of the most lucid comments I've ever heard, we actually used this in an academic paper, was a very deep thinker who, by the name of Mike Tyson, who said that everybody's got a plan till they get punched in the face. And, I think that sort of describes what we're dealing with. You're talking about Gaussian copulas dealing with tail risk issues. And yeah, to the extent that you've observed the data, they can describe the observed non-linear nature of this dependent structure, and that can be very useful. And I think that's certainly better than using a covariance matrix. At least it's a step in the right direction. But, we haven't seen all that can evolve out of this. And quite honestly, from a selfish traderly perspective, which is what I'm told I'm supposed to have, I think some of the most interesting investment opportunities are those investment opportunities which seek to take advantage of some of the corners that various strategies are going to get themselves into. And as you see the unwinds that take place as a result of this. For example, we had one manager who's typically very quiet, was up 67% last month because the ABX was melting down. So there's a lot of interesting stuff to do. But
Wonderful thoughts. I think that question, so liquidity enhanced, the distribution of risk enhanced, people in turn take on more risk, and then the whole question of whether the level of asset prices is sort of persistently affected by some of these strategies, as one might think is possible if you really thought that the conundrum, the Greenspan conundrum and the yield curve is actually being influenced by this stuff. Those are sort of three distinct domains of influence on markets, and all of them very, very interesting. Other questions, please. You, sir.
Yes. I have a question about validating the models, both before going online and as you go online. In other words, do you have any war stories on when do you pull the plug on the model, or do you use the model a lot more than you initially thought you would want to use? So do you have any stories on models in real life and how you deal with them when they go online?
Great, thank you. So the question is about model validation. How do you do your validation? When do you think about putting it online? At what point do you think about pulling the plug? How do we make sure those models are valid?
I can give you about 100 horror stories, but we don't have enough time, even if we went the whole week. I'll back up a bit. So what's a model? There's two different types of models in the world. There are statistical models where you say, I actually have no idea how anything works, but this is sort of empirically how I think about things. And then there's models that say, there's some sort of a fundamental law. If I threw this pen hard enough and I sort of ignored air, I can tell you exactly precisely to a centimeter where this will be in 1,000,000 years from now, because gravity is pretty simple stuff and there's not that much friction. I can use all the computers in the world and I have no idea where IBM is going to be tomorrow, because that's all empirical. Half of you will grow up and continue your careers thinking that there is no difference between simulating IBM and simulating the space shuttle. Space shuttle, it's a lot easier. And those half of you who insist that there are fundamental laws, you could really annoy the other half of the people in the room who know that there aren't fundamental laws. So the problem with modeling is that you have to first realize that you're not modeling a real physical process. There's no law that says this is the way things have to work. They just sort of seem to work out that way. So then you have to use the other side of your brain and say, when is it going to break? Why should I believe this? So the successful quantitative person is someone who never believes what they think they know. So it's not up to someone else to prove that you're wrong. It's you go to sleep every night worrying, I think I'm wrong. I think everything that I believed over the last 5 years is completely wrong. You will wake up in the morning very tired, and you'll be very successful in your career. If you sleep soundly knowing it must be that way, then it must be that way as your NAV goes down and down and down and down. So it's really around understanding that. A good horror story, one of the hedge funds I was at, we came up with a fabulous model. We found that the European currencies were banded. There was just no conceivable way that they can break these bands. And then we said, and in fact, there's a simple reason for that. There's a law that says that the European currencies were tied together, and that the central banks had to intervene to buy or sell currencies to get them back together. And we back-tested that for 7 years on daily data. And the data was pristine, and the back-testing was pristine, and we created a fund, and we launched the fund, and we thought that we were going to make 37% with no more than a 5% drawdown. And then in marketing, so we haven't raised money yet, but during the marketing phase of that, 2 months before launch.
This is 1992?
That was 92. So ERM mechanism completely blew up. So good thing we sort of skirted disaster, and people said, wow, you guys were really smart. You saw that coming. No, we were just really inefficient in getting our marketing material out. So the rule is A, don't sleep well at night, and B, it's good to be lazy sometimes, because sometimes things just work themselves out before you know it.
Thank you. One wonderful answer. I think part of the art of knowing when you can go further back into the data, and when you know the world is changing so fast that that's not a legitimate strategy, that's part of the art of being a quant. Anybody else want to add to that? It's an important question, but we can, please.
I would say, in my experience, when I said earlier that things are really changing, even in the way, if I had to go back and model, literally do the raw work and model and discover, let's say, patterns in data and do an actual data mining exercise, things have really changed in the last 3 to 4 years. And 3 or 4 years ago, I think I would have never expected to consider anomalies or error terms linked to, for instance, geopolitical effects of facts. And in a way, when now I'm, talking to managers or I'm looking at a new product, I'm really trying to figure it out if the skill set I'm looking at and, the counterpart is offering as really an alpha generator for itself, or is just another way of add risk premium and, boost your risk profile, okay, so that the reward is higher simply because you're taking on more risk. And I think, once again, 3 to 4 years ago, I would have never expected, for instance, modeling Australian stocks to letting there a plug for a Chinese activity or Chinese trade or anything like that. Or if I were to model any trends within a shipping industry in Greece, I would have never expected to model in there any other factors coming out of Latin America as well. And that means I had to step out of the mathematical rules or the rule of law that I thought I knew, okay, and the modeling I thought that they were almost, written down, gold, and those are, they're going to stay there forever, realizing that there are other factors that are purely behavioral, psychological, and, in the field of behavioral finance that you can agree or disagree with, that you need to be comfortable in exploring at some point. And actually that's where, my research interest and where my, just activity on a daily basis is going towards, and in understanding what that anomaly is and what's the next anomaly that will create the next alpha is and resides, and getting there ahead of everyone else. Not too early, because otherwise I would be making, I would be the market maker, just one person in itself. It's not going to be easy. But getting there, at the same time that, a few other people are, so that, I find a market that is liquid enough for me to trade in and out and to exit if anything else happens.
That's great. There's a question in the back here somewhere. Please, sir. Yes.
Dealing with data quality, the world contains a lot of errors, and you may have a perfect model, but reality sometimes plays tricks.
So
That's your experience in that area.
So the question is data quality, a very, very important part of what we do. How do we ensure that we've got some confidence about the quality of our data?
Why don't you go ahead?
Well, yeah, I mean, briefly, we see this especially in calibrating models to volatility surfaces. For instance, if you look at S&P 500 data today, if you look at the options data, and you look at the skew, and you look at successive months, you'll probably find that some of the equations in John Hull's book are violated. You'll probably find that convexity is violated for a few of these things, because you didn't have simultaneity of prices. For a number of reasons, you won't have that. Just staying on this S&P 500 for a minute, because I wanted to, the latest Journal of Derivatives, which is a publication of Institutional Investor, and is what? IAFE, you can get a discount with this, has something on third-order Greeks, okay? In other words, worrying about not only delta and gamma, but worried about the derivative of gamma with respect to spot, or what some people call omega. And they claim that you have to get, like 25 different Greeks just to do S&P 500 vanilla, options book, which is scary. So, and sort of like, what is model validation? But there are some heuristic checks that you can put in. If you fit, for instance, a local volatility model, the peer local volatility model, you can check. You can make sure that you don't have arbitrages in that in volatility space. I think it's more the art of calibration. Like in fixed income, for instance, you have a complicated structure. It's struck out of the money. Do you calibrate from at the money European swaptions? Do you calibrate for at the strike swaptions? Do you do a mixture in the Q? And nobody can really say, unfortunately. So calibration might be more of an art.
Other thoughts on data? Please.
Data is everything. So it's the most important aspect of most things, but certainly in finance. Data quality in finance has always been an issue to the point that data becomes very proprietary. I think a gentleman asked a question about what are the biggest changes over the last N years in finance. Certainly the availability of computers to do calculations is one, but nothing destroys a strategy as all of a sudden data about the strategy is out there that everybody can use. So data is often held very closely. You can learn the most about markets by data, by looking at the data from the markets. Unfortunately, most textbooks, so if you go into a bookstore and you buy books, they sort of ignore the practical ramifications of data, and you don't really understand how data works until you start to try it and you get burnt once, twice, 3 times, etc. There is no such thing as perfect data, but you don't need perfect data, but you do need good data. So you should focus a lot on how do I continue to make sure I get better and better data, but always knowing that the data is always wrong. which means that you have to have models that work well with bad data. And if your model becomes so sensitive so that if a small error in the data is a big difference in a P&L at the end of the day, then it's not the problem of the data, the problem is the model itself.
I have a particular problem with data. That is, it's not so much that the data is inaccurate, although it is from time to time. It's just that it's generally kind of short. And so you don't necessarily have essentially at your disposal a collection of return outcomes that will allow you to sort of sit down and using standard methods derive some sort of a distribution function or some sort of kernel estimation of what the payoffs really look like from something. Take, for example, a manager. So that that can be very difficult, and in particular in the hedge fund industry, where there are real incentives to developing trading strategies that have highly left-tail skewed, highly leptokurtotic return patterns. Because when you have a trading strategy that is that, it will have a very high modal rate of return. Your typical day is going to look like your best day. And even if you don't add any value, you can exist for a very long period of time, essentially mimicking someone who does present a lot of value right up until you crater. And so that's a big issue. So it's almost a form of financial Heisenberg's uncertainty principle, where the moment I have enough data to characterize the fact that he has, 55, as a measure of his kurtosis, the guy goes out of business, and very few managers stick around and say, look, we're still out of business, and here's our latest return outcome, nothing, because it doesn't work that way, right? So this is, and this is just sort of a side note, just to give you a sense of who I am as a person, so you can think less of me. I remember having this conversation with my dad about Heisenberg's uncertainty, and he related a story about a young lady he knew in college by the name of Shirley Heisenberg, but this is a completely different issue, so with that, I'll leave it alone.
If I could try a question,
some people know Shirley.
a question that came up that I think Alicia touched on it, but as some of these people are thinking about the educational side. So when we go from answering the questions to knowing what questions to ask, right? I mean, part of the real value, you mentioned communications, that idea that, okay, I know this side, and I can also talk to people over here that may be buyers, right? And there's, whether it's communications or the economics, right? The economic context of understanding what questions to ask. And so as you think about becoming a quant and the importance of the people skills, the economic context, are those parts getting more important, the communication and economic context, or is there plenty of room for quants that just say, look, I'm not going to do that part. I'm really great at the quants and the quant part of it, per se.
As you go through your quant life and you mature in a position, it's important that a pure quant background doesn't hold you back. It's important that your own conviction, that you just develop, okay, and that fulfillment that you have after you've created the next great model. You have had a lot of other people that work on your team shine just because you were a fantastic you came out with a breakthrough research exercise, and that particular XYZ client bought on it. They made tons of money out of it. The firm is putting on the table their own capital to back that. There is a lot of personal satisfaction in just, and a lot of people, it depends also on the personality. If you're a person that says, you know what, I'm really more, on the, I'm really, really, really love just being there, analyzing data, and that's really all, I want. That's great. I'm just saying that you need to have, don't put, all your eggs just in one basket, and you have to be willing to mature in your role, because once again I think 3 years ago, I didn't even want the responsibility of actually going and explaining to a client why I decided to use that particular function and why I normalized the return and why I treated NA's value some other way, interpolation here and there. I was actually thinking, you know what, I know better than that. Why do I have to spend half an hour explaining this one guy that doesn't even know what actually, mean reversion is, why I have just, recalibrated the model this way and why I rebalance a portfolio in this way. It's like, forget it. The actual returns and the performance, of the model will speak for themselves. Now, once again, 4 or 5 years later, what you say is you want not only to continue to love what you do, but you want to add value. And by the way, you want to become a sort of leader in what you do and also be a mentor. And in order to be a mentor and mentor the next junior quant, you need to know how to speak with whoever is on the opposite side of the table, whoever, less sophisticated, more sophisticated. So my really strong recommendation to you guys is, no matter if you're thinking about going into a quantitative program, if you're thinking about a switch of career, if you already have a quantitative program background, always think about making sure that nothing holds you back if you want to proceed in one direction or the other. Because once again, when, for instance, I talk informally with friend or referrals from school or candidates that come in, the very first thing I'm interested in is this person able to dissect a problem and completely understand what's behind that? Is this person able to ask the right question? I don't want the right answer. To me, there's no such thing as right answer, especially in markets. Okay, tomorrow the world can be completely different. 9/11, the day after, the world was absolutely a different story. So once again, the most important part for me is understanding the framework behind your thinking.
Very helpful. I'll go to the next question, please, sir.
In terms of fundamental laws and mathematical sophistication, it seems like now you see a lot of books where, articles where they're using methods from quantum field theory to try to explain markets. What do you see as kind of the feature of mathematical sophistication in this field and the tool set as it kind of expands? And what's going to be useful, what seems to be useful and what doesn't?
Right, so the question is, when thinking about the fundamental laws that we're working with, and in particular the mathematical sophistication, and within that mathematical tool set, what is the future of that tool set? Where is it going? What are the particular domains within mathematical tools that are getting more relevant going forward?
I'll take a stab at this, and it may not be the answer that you think. I went to a friend's daughter's bat mitzvah and sat next to Sasha Migdal, who's pretty handy with a calculator by any stretch of the imagination, and he's the Princeton University guy, one of the world's foremost authorities on string theory, and he actually created his own hedge fund, and he did it about 3 years ago, and he's buzzing along now. He's been making about 40% a year. He has yet to have a losing day. His fund is at capacity at $15 million. That's it. That's all he can handle. He does about 8,500 transactions a day. And, he sort of proceeded through the dinner and became increasingly liquored up because he's Russian and they'll do that. And he was very open about what he did. Basically, it wasn't so much that he did anything particularly otherworldly in terms of the set. It was really a frame of mind. It was being really rigorous about what he was thinking. It was about coming up with short-term forecasts. It was about shrinking the forecast space. It was about very de minimis and lots of little incremental good ideas and being very rigorous in terms of the research process. So I think more than anything, it is, and I think he's right. It's transferring a framework, a way of thinking in a very rigorous, meticulous fashion. The other thing that happened, which was similar to that, was a dinner that the IAFE had a few weeks back where we give Jim Simons the award. And Marty Leibowitz got up and gave a talk, and he basically noted that we had been served medallions of beef, and Jim's firm is called Medallion, or at least the premier fund, and it had this sort of red sauce on it, which he called secret sauce. And he said, I don't think many of you noticed, but we gave you a medallion with their secret sauce, and you fools, you ate it. All right? And there was actually a little bit more truth to the matter than you would guess, because basically Jim had gotten up and given a speech and said, look, I've invited, a third of my staff, of my research staff. They were everywhere. They were like ants. And he actually has hired 78 PhDs so far. And he never fires anyone. Just, if you can't do that, you'll do something else. And basically, if you can come up with, 200 okay ideas and fit them together and create something that's, a couple hundred of orthogonal ideas, basically, you got something pretty powerful. I mean, you work out the math on something that's right 51% of the time, or right 38% of the time, but more profitable when it's right than when it's wrong. And so there's a lot of mystique that goes into what sort of techniques. Now, you've seen everything being applied. I mean, I have close personal friends who've attempted to employ gauge theory as a better approach for looking at purchasing power parity as a way of forecasting exchange rate movements. A guy by the name of Eric Weinstein, brilliant guy, Harvard mathematician. We've seen Benoit Mandelbrot applying fractal dynamics so there's anything you want to do, just do. I mean, anything. You fry it, people will try it. Don't get wedded to any one particular idea. People do everything. I mean, everything. So.
Thank you. Other thoughts on that question? Particular tools? Okay, if we could take time for some more questions. I want to make sure the back is represented. Please, sir, go ahead. Yep.
What are the implications Congress pushes transparency on the market today?
Okay, so the question of transparency and regulation, if transparency is pushed on the hedge funds and maybe even more extensive than that, what happens to the markets? What happens to the industry? Any thoughts on transparency or regulatory context more generally?
Can I ask the risk guys a question that relates? Yeah. Is it possible to have transparency?
Yeah.
Since we have a product that does exactly that, I guess I have to comment on that. I'm not sure how much that has to do with how I became a quant. We can certainly discuss this for hours, so I'll make my answer very brief. It will have an impact, a significant impact. I'll expand on that a bit. We are at an inflection point in terms of the alternative investment industry as a whole, and that's more than just hedge funds, but taking it in the broadest sense, everything from private equities to prime brokers, etc. The government is interested because it has grown to a proportion where there can be knock-on effects to other industries, and that's why there's an interest in this. And I think whenever the government gets interested in things like that, there's usually some middle ground. We've seen that just making regulations saying this is what you're supposed to do doesn't work, because that got reversed a year later or a year and a half later. But there will be something over the next few years that will make it easier for people to invest in hedge funds, and will make hedge funds even more money than they're making today. So there will be continued improvements in this industry, whether or not Congress does anything. But if they do something, I believe it will only actually improve things as opposed to detract from them.
Please.
I think I got a quick angle on that, and maybe bring it back to how I became a quant or what quant thing. We see our clients they're looking at buying hedge fund derivatives right now. So it's like a call option. I think Barclays has one out there, for instance. Probably the other panelists. So you might have like 5 or 10 hedge funds in a basket. Now, if they were stocks, you could go out and you could see their implied vols, and you could make some sort of multivariate Gaussian model, or maybe even make a local volatility model for the basket. With a hedge fund, I mean, there aren't options on the individual hedge fund, so probably you have to use historical volatility. But I don't even think you have that right now, right? They report something every quarter, and so I think it would certainly be good for the business, and it would be good for quants to have these calls and puts on hedge fund baskets.
It's an interesting question. Just a quick side note. There was, in private equity, a related industry. There was so it was a public institution. It was the University of California that they imposed some transparency on their investments, the endowment investments, some of which was in private equity. And they were thrown out of some of those private equity and venture funds very, very quickly. And then the regulation was changed. But there's a lot of sensitivity, obviously, on that dimension. Other thoughts, please? We do have some time left. Please, sir.
Sure. Two questions. One, if the industry moves towards more regulations, the returns will become like telecom industry. And I'll leave it at that.
Oh.
I would be interested in your perspective on that. The second part is, do you think like a multidisciplinary perspective would help generate superior returns? What I mean by that is people coming from outside the industry, rather than the finance industry itself, into this industry and then helping develop the models and returns.
Yeah. Okay, so the first thought was we might want to jump to the second piece, but the first part was very relevant. I think it was a statement as much as a question, the notion that as you regulate, you may push it more and more toward sort of there isn't much room to play anymore, more like telecoms if it's overregulated, perhaps the way telecoms used to be. The second question, though, in terms of infusing greater energy, and the source in the second question, what was the driver in your second question? Just new other disciplines, the cross-disciplinary notion that as we think about what have you, other disciplines other than, say, mathematics or statistics.
There's a Canadian economist who'd done a study on the telecoms and came up with a strategy, an investment strategy that actually outperformed his telecom investment in Nordtel, which was he went out and bought a case of beer and he drank the beer and then he returned the bottles and got his deposit money back on the bottles. It actually worked out better than his telecom investing. He got to have some fun in the intervening period. I think we're dealing with in this building and a lot of very wily people who, will find a way to circumvent regulation, or rather, the more appropriate way to describe it would be to peacefully coexist with it. I mean, they always have, and that's why we hire lawyers. They do some magic bullshit, and the problem goes away, and they figure out some other way of doing stuff. So I'm not really worried about that. Also, I don't think there's any way of regulating something that you don't understand particularly well. Transparency, great issue. For me, I put on a trade where I buy a double binary. My real bet is on an implied correlation bet. I throw that into a portfolio, and someone's going to warehouse the two volatility pieces and not really know even what question to ask about the bet that I've made. I have a forward volatility, or I take 100% of my capital, invest in an at-the-money straddle that expires at the end of the month. Guess what my delta equivalent exposure is? 0, because it's at the money. So, there's a whole series of dimensions of looking at portfolios, transparency, regulation. I think that the guys, the engineers, the guys trading, the guys doing stuff are going to be so far beyond anything that a regulator, some dude in Washington is going to be able to do something about. It's almost not worth me worrying about. Bringing people in from other areas, Jim Simons, man, he denuded IBM of their voice recognition group. These are all guys who are specialists in signal processing. Not one of them knew a stock from a bond, and they had a whole lot of real valuable things to contribute. So, absolutely.
And we certainly see it in the finance research, right? Obviously, behavioral finance with deep connection to psychology, agent-based models. A lot of that comes from evolutionary biology and other fields. So we're seeing. Anybody else want to comment on the sort of cross-disciplinary bit of the question? Okay, we can take another question in back there, sir. All the way back. Thanks. Okay, so the question was, engineer with no finance background, would you recommend you go into a financial engineering program before you have any experience as a quant or in finance, quantitative finance?
That's completely based on what you want to do for the next 2 or 3 years. You can go in either direction. You do not have to get a financial degree or do a formal training in financial if you have an engineering background. When we recruit people, what we say is, There are certain things we can teach you and other things we can't teach you. We can't teach you how to think. So come in knowing how to think. We're not going to teach you math. We're not going to teach you statistics. You need to know that information. We can teach you a lot about finance on the job. Will you be able to do a lot more on day one? Absolutely. So where you will be shut out will be for positions where people are saying, we need someone who can rattle off Black-Scholes models in their head. You won't be able to get that job. But there are tons of jobs out there where there are people who are more than willing to hire people with the engineering background, and in many cases, people who refuse to hire someone with the financial background because they are looking to be the ones to teach them finance. They don't want anybody else teaching them finance. So really the decision should be, do I want to get a financial engineering degree? Not what job do I want later? Because it's a hard degree to do, and you're going to be doing it for a number of years. You need to be happy doing that. So you should really think about it just as a not an end to a means, but do I really want to do that for the next few years?
Thanks. There are a couple of questions over here. I've been neglecting you, sir, at the front, and then I'll take you in back after that.
How is the role of a quant with a master's degree different from a PhD guy?
So the question is the role of a quant in the industry with a master's degree as opposed to PhD background.
And I'll actually take that because that pretty much is my story. I have a master's degree in financial math, and a lot of my colleagues, when I actually got, a lot of my colleagues, there were, at the time, it was just 6 of us, okay, in the program. 4 of the 5 decided to actually pursue a PhD, continuing a PhD in financial engineering, and Stanford was actually starting off that program that year, and they just thought, by the way, this would give us. The rationale behind that choice was more, it will give us more time to think what we actually want to do instead of throwing ourselves actually out there in the industry, to be very honest with that. That was the rationale, not because they thought we're going to land up better jobs after that. Actually, they ended up, getting pretty much started where I got started. I think that in my experience, okay, and as I said earlier, it's very important the way, and as you point out, it's very important the way you think and the way you actually know how to slice and dice a problem and go around it. I don't think that, once again, in my experience, I was sort of in a disadvantage when I was actually comparing, modeling skills, or when I was actually competing, for, a different seat with a PhD candidate. I don't think so. What I would actually recommend, and I would actually go back to the question that was raised earlier about, an engineering background going into a financial math program or not, pursuing, a PhD maybe, is that, and once again, in my experience and what I've seen out of a few colleagues in different parts of Wall Street, was that it's very beneficial, and I found very beneficial to actually have some work background, okay, in the field before deciding what to do in grad school, if you want to be a specialist with a master program within a particular field. And actually what in some of the programs, especially in FinMath, they really don't have a sort of standard format, okay? And so it's very hard to make a comparison, within the pool of programs that are actually out there. They assess and target and prepare you for, in my opinion, quite different roles at the end. Very different. Some are more, computer science type of background. Some others are great on the risk side, okay, if you want to become a risk specialist. Some others are fantastic on a statistical perspective, on a data mining perspective. And some of the programs that are out there actually leave it up to you. So other than 3 or 4 required courses, they ask you, okay, you choose what kind of line of program you want to get out of the 2 years that you spend on campus. And at that point, at least, that's the situation at Stanford. It was, okay, we require you to have completed this, X, Y, Z, okay? If, the PDEs are just, the minimum requirement. After that, you have to have SDs and so on and so forth. But without having in mind at least what's out there, or without having the sort of informational background, you may risk to end up in a position that you really didn't know what you were signing up for. And so the extra due diligence is really needed. Either, through a former experience, in the field, okay, maybe at a very junior level, and then going back, to school, or through people that are actually in the industry that are, that are genuine, that will speak to you with the truth, and they're not just trying to hire you or recruit you or fill in, a seat. Because once again, it's very important that you're passionate about what you do. This is what I always tell people, because you're going to spend a lot of time at work, really a big portion of all your entire day, and you want to make sure that you're really doing, and you are using your time in the best way ever, and you're saying, okay, I get out of here today that I learned something more. If you don't think that position earns you that right, then it's definitely not for you.
Thanks, Alicia. I mean, I think the important point, of course, is there are many pathways into this thing we're calling quant, and many pathways through it, and that's part of hopefully why you're here, is to get some sense for what those look like. In the back, there was a question there. Yes, sir.
Good evening. My name is Fitzgerald from Brooklyn College, also a PhD candidate. However, I'm not looking forward to the research part. I want to know, I still want to teach though. Now, will it be a master's degree would be preferably, or a PhD? Because this industry is growing, as we know, from 10 years from now. And we need more educators as well, as long as we're getting a lot of wants, which is great, but we need more educators. So what would you say, who wants to be a professor but not looking for the research part, but still want to teach?
Got it. So the question revolves more around teaching and whether a master's degree is enough for going ahead on the teaching front if one wants to mostly teach as opposed to research. Is the PhD most important for that? I may be the right person to address that one, so I'll give that one a try. I guess it really depends on the kind of teaching that you want to do. I mean, if you want to teach in one of the top MFE programs in the country, you're going to need a PhD. They're just not going to give you access without that kind of background. So that is an important card, I think, for many of those programs. But I don't want to play that too strongly. There's certainly a lot of people with master's level training and a lot of room to do teaching. So it's the kind of teaching that you want to do. But I think the more formal you want to get, and the more at the center of the action, if you will, the more important or even essential it is to have the PhD to do that teaching. We may have time for one more question, but that would be it. I may have forsaken this side of the room a little, so I'll take this one here. Go ahead, sir. Oh, you did ask a question. I'm sorry. That's not fair. You, sir, please. Thanks.
Having benefited from what you know now and the experiences you've gone through, what advice would you give someone who's just starting out, maybe at the undergraduate level? Like what should they study and what courses would you be focusing on?
So if somebody is at the undergraduate level of their career, knowing what you know now, what would you focus on? Courses you'd take, things you'd do?
I have to take that because that sounds like the Hillary Clinton question up in New Hampshire. So, and to go back, just like a politician, to go back and answer another question. When I was in the Columbia Mathematics of Finance program, there were undergraduates or people who had just graduated from Columbia and other institutions, and then went into the financial engineering program. So I have a pretty good sense of the undergraduate background. I think one thing I would say is if you're a new graduate, then I would recommend working in an industry for a year or two, just so you get some perspective on what you're doing. I mean, a lot of these students had, I'm sure, taken linear algebra, but they couldn't find the eigenvalues in a 3x3 matrix, and that was on the first homework assignment. I hadn't studied linear algebra for 20 years when I went back in this thing, and it was a piece of cake, doing that, so because you use it in physics all the time. So undergraduates, I don't know how much is available there. I think economics is certainly good. My two professors, Alan Blinder and Harvey Rosen, were both very good. I didn't get Ben Bernanke because I wasn't smart enough to figure out how to take a class with him. But get a taste for things. That's what undergraduate's about, and get a taste for finance.
Any other quick comments on that?
Yeah, for me, just based on my experience, this one's easy. So you're just starting an undergraduate program? In the middle, you should go through the course book and find the courses that you're interested in taking. That's it. Do not think about what you're going to do with that. Now, if it turns out that you say, a lot of the courses that I'm interested in taking tend to be very mathematical and tend to be very quantitative, then you'll be on the road to become a quant. If it turns out that the classes that you think are the most interesting are not particularly quantitative, then that's telling you something else. So that's what you should be looking at. Is just what do you want to do for the next 2 years?
I want to thank all of our panelists. Their comments have been really helpful. I want to thank the AI.